On June 14th, U.S. 5-year Treasury yields traded a high of 3.59% before collapsing to a current level of 2.84 amid growing recession concerns, and now sits 17 basis points below the current 2-year yield. Now, this comes the day before the Fed's meeting, and according to Fed Funds Futures, there's a 75% chance of a 75 basis point hike and a 25% chance of 100 basis points. This Fed meeting is somewhat inconveniently timed between the July 13th CPI read, which showed that staggering 9.1% year-over-year increase, with the next CPI release, which isn't until August 10th. The 5-year part of the curve is generally viewed as the inflection point between short end rates, which are largely controlled by the Fed, and long end, which is more controlled by market forces, despite the Fed's recent involvement in longer-dated treasuries. Now, if a trader believes that the 5-year U.S. Treasury yield is headed lower, perhaps in response to an increasing recession threat hastened by an over-aggressive Fed, they could express that by selling the micro-July 5-year Treasury yield futures contract at 2.86 and target a move to the March highs of 2.55. A stop for this trade could be placed above at 3.05. This trade could make $310 if your target is reached and risks $190 if you're stopped at your level. Now, we're looking at the July contract in these micros, which expires on July 29th. So if you want to keep this trade on past that date, you'll need to roll it into the August contract. Now, if a trader believes that rates could head higher from here, perhaps from 1, a perception that the Fed is moving too slow, or 2, that inflation is going to remain a challenge and increase the carrying costs of holding longer-term bonds, they could express that by buying the micro 5-year July Treasury yield futures contract at 2.86 and target a return to the June highs of 3.59. A stop for this trade could be placed below at 2.50. This trade could make $730 if your target is reached and risks $360 if you're stopped out of your level.